Welcome to the deep dive. Today, we are popping the hood on some fascinating financial machinery for you.
Yeah, we're cutting right through the noise today.
Exactly. We're looking at the cold, hard data of the Hush investment strategies. So, we're going to examine their three main portfolios, which are the Protector, the Strategist, and the Adventurer.
Right, the three different tiers.
Yeah, and we are specifically looking at their track records from their inception all the way up through February of 2026.
And just to set the ground rules for you listening, today is entirely about the what and the how.
Right, we are not fortune tellers here.
Definitely not. We aren't here to predict the future, and we certainly aren't giving investment advice. And when we look at this telemetry, we are strictly focusing on net of fees performance. Furthermore, to really understand if this machine is running well, you have to race it against a real competitor.
Right, you need a benchmark.
Yes. So throughout this deep dive, you'll hear us compare these Hush strategies against a very specific benchmark, the iShares Core Growth Allocation ETF, which goes by the ticker AOR.
AOR is an investable exchange-traded fund. It's a real vehicle with its own internal operating expenses. So using it makes this a true apples-to-apples race. So before we look at the final lap times, the actual returns of the three portfolios, we really need to understand the engine that's driving them.
Yeah, we have to look at the mechanics of this system.
Right.
These strategies are built upon the quantitative research and system design of a guy named Andreas Klenau. But what's crucial to understand for our deep dive today is the delivery mechanism. The algorithms execute his quantitative framework automatically, and the core philosophy powering that entire framework is a concept called dynamic momentum.
How does the machine actually define momentum? Because my instinct is to just say, oh, it's whatever is going up the fastest.
Right, and that is the exact misconception that gets human investors into a lot of trouble.
Really?
Yeah. Fast often means reckless.
Yeah.
The Hush algorithm doesn't just look for speed, it measures the health and the risk-adjusted strength of price trends across asset classes all over the world.
Oh, okay. Unpack health for me in a mathematical sense. Like, how does a machine know if a trend is actually healthy?
Well, think about it like a telemetry graph, right? If a stock's jumping around wildly.
Like a meme stock or something.
Exactly. Up 5% one day, down 4% the next, up 8% the day after. That is a highly volatile, erratic curve.
It's all over the place.
Right. What the algorithm defines as a healthy trend is a smooth, steady, consistent upward trajectory over a period of months.
Oh, okay.
Essentially measuring how closely an asset's price sticks to a smooth upward path without violent swings.
Okay, so it's looking for traction, really, not just raw horsepower.
Precisely. And once it identifies where the best traction is globally, it dynamically adjusts the amount of capital put into each market based on that underlying mathematical health.
But it doesn't just go all in on one thing, right?
No. All the while, it maintains a diversified footprint. It holds stocks, bonds, and alternative assets globally at all times. It just, shifts gears and reallocates weight to the wheels that have the best grip on the road.
Right. And I guess how much weight it shifts into the highest octane, most volatile asset class, which is equities or stocks, depends entirely on the chassis you choose to drive.
That's a great way to put it.
Which brings us to the three specific risk flavors here: the Protector, the Strategist, and the Adventurer. So let's start with the most conservative setup in the fleet. Risk level 1, the Protector.
Yeah, the Protector holds the lowest baseline amount of stocks among the three portfolios.
That makes sense.
Exactly. Its primary job, as the name implies, is to mitigate risk and manage volatility while still, participating in broader market growth.
And the numbers here are really interesting. Looking at the data from its inception in February 2024 all the way through February 2026, the Protector achieved a net of fees return of positive 27.82%.
Okay, and let's bring in our competitor. How did that investable benchmark, the AAR ETF, perform over that exact same 2-year stretch?
So the AOR came in at positive 27.64%.
Gotcha.
So the Protector edged it out by a very slim 0.19%. And the Protector's volatility sat at a highly controlled 9.2%, with its worst drawdown, like its biggest temporary dip, maxing out at negative 9.86%.
The purpose of the Protector isn't to dramatically outpace the market in a massive bull run.
Okay, explain how that changes the math for someone holding the Protector.
Well, the market experiences a massive, violent drop right when you need your money the most. So the protector's dynamic momentum is engineered to prevent those deep drawdowns that destroy the magic of compound interest.
So it's playing defense.
Heavy defense. The system caught some massive global trends to offset its defensive posture.
And looking at the data, one of those massive trends was actually commodities. Like silver-related holdings alone contributed 1.32% to the protector's total return during that period.
Which perfectly illustrates the diversification at work, right? It's not just holding fewer tech stocks to be safe. It's actively shifting capital into entirely different asset classes like precious metals when the mathematical health of those trends strengthens.
It cornered smoothly without losing speed.
Exactly.
Okay, so that's the defensive setup. Let's turn the dial up to the strategist.
All right, the strategist. It sits right in the middle of the lineup. It holds a higher baseline proportion of stocks than the protector, but less than the highest risk tier.
From its inception, in July 2024 through February 2026, the strategist generated a net of fees return of positive 30.87%.
And how did the AOR benchmark fare over that same window?
The AOR ETF came in at positive 21.38%.
Wow.
Right, so the strategist didn't just edge it out, it outperformed the investable benchmark by 9.49 percentage points.
And what's truly fascinating when you look at the telemetry for the strategist is where that outperformance actually originated.
Because it wasn't just riding the standard U.S. market, was it?
No, not at all. The data shows heavy lifting coming from emerging markets and international equities.
So outside the U.S.,
The iShares Latin America ETF, the ILF, contributed 3.64% to the strategist's overall returns. Canadian equities added another 1.85%, and Japan added 1.53%. So when Latin America started showing that smooth, steady upward trajectory we talked about,
it just bought in.
it simply allocated more fuel to that engine.
Yeah. Okay, so we've seen the defensive mechanics with the protector and the highly balanced, globally driven approach with a strategist. Now we have to move to the high equity, highest risk engine in the Hush Garage.
So the adventurer holds the highest baseline amount of stocks. It is explicitly designed to capture the maximum potential return the dynamic momentum system is capable of generating.
But there's a catch, right?
There's always a catch. We have to be absolutely clear here. As a direct result of that design, it will experience the most turbulence on the track.
From its inception in April 2024 through February 2026, the adventurer hit a net of fees return of positive 35.87%. The AOR benchmark over that exact same period was positive 26.68%. So the adventurer outpaced the benchmark by 9.19 percentage points.
Huge difference.
Yeah. And if we just look at the very beginning of 2026 alone, like just January and February, the adventurer was already up positive 8.72% net of fees year to date.
But this brings us right back to the physics of the machine, as we were saying. We must look at the trade-off. Higher equity exposure fundamentally means higher volatility.
Right, you feel the bumps more.
The adventurer's volatility over that period was 11.9%, and its maximum drawdown during that nearly two-year stretch was negative 12.80%.
Meaning that at some point during that run, the portfolio value temporarily dropped nearly 13% from its peak.
It requires an entirely different stomach from the investor. You have to be willing to endure the chassis rattling.
Yeah, you can't panic and hit the brakes.
No, you can't. And we always have to remind ourselves that these numbers illustrate how the system did behave in the past, right? Historical performance is never a guarantee of future results. But looking backwards at this data through February 2026, the adventurer perfectly illustrates the exact trade-off between risk and potential reward that the Hush framework is built upon.
And just like we saw with the strategist, the adventurer's gains were driven by that wide global footprint. Latin America contributed a 4.26% to the adventurer's total return.
Wow.
Yeah. Canada contributed 2.16%, and Japanese equities added 1.78%. It's actually amazing how consistent those global performance drivers were across the different risk profiles.
And well, that consistency exists because the underlying momentum engine is exactly the same across all three. The algorithm identifies Latin America as a healthy trend globally. It then automatically allocates weight to that trend across the protector, the strategist, and the adventurer.
Just in different amounts.
Just in different total proportions based on the specific risk ceiling of each portfolio.
Okay, we've spent a lot of time looking at what the returns were. But for me, the real aha moment comes from looking under the hood at how the software actually behaved in real time just a few weeks ago.
Oh, the recent shifts.
Yeah. Let's look at the specific granular allocation shifts the algorithm made between January and February of 2026.
This is where the theory becomes practice.
Let's frame this as a real-time pit stop. Like, what adjustments did the algorithm make to the suspension? Who got swapped out, and what new parts got bolted on between January and February?
Well, if we look closely at the telemetry for the Adventurer and Strategist portfolios, the algorithm distinctly stepped back from some of its biggest historical winners. It reduced its exposure to Canadian equities. But much more notably, it significantly trimmed its positions in the U.S. technology sector and the U.S. healthcare sector.
Let's put some specific numbers to that. In the Strategist portfolio, the allocation to U.S. tech dropped from 3.3% down to 2.3%. In the Adventurer, U.S. tech dropped from 3.8% down to 2.6%. That is a very noticeable, deliberate haircut to the tech sector.
It is a decisive move.
Yeah. And the data shows us exactly where that capital was redeployed. It followed the momentum internationally.
Japan became a massive recipient of this reallocation.
The iShares Japan ETF, ticker FLJP, saw a dramatic, immediate increase.
In the Adventurer portfolio, the allocation to Japan surged from 4.2% up to 6.1% between January and February. And we saw this same scaling applied proportionally in the Strategist and Protector tiers.
And it is worth noting that the algorithm wasn't just hunting for yield in Asia, it was constantly scanning for highly localized trend health across the globe.
The European allocations prove that.
They really do.
If we look at the Strategist portfolio leading into and overlapping this early 2026 period, the data shows it aggressively bumped its allocation to Switzerland, ticker EWL, up to 3.7%.
It simultaneously increased its weight in Italy, ticker EWI, up to 2.5%.
And simultaneously, as it pulled capital out of U.S. tech, it leaned heavily into new emerging trends.
Like what?
Across the board, it increased positions in broad commodities, and it significantly bumped up its allocation to Australia. When the risk-adjusted momentum data shifted in February 2026,
When the math indicated that the tech trend was maybe becoming too volatile?
right, or overextended, or simply losing its underlying health relative to other global assets.
Yeah.
When that happened, the allocation shifted silently and efficiently.
It didn't dump it entirely.
No, the system always maintains broad diversification across the 80 ETFs, but it clearly recognized that the momentum in U.S. tech was cooling off relative to the rest of the world.
All right, let's bring this all together. We've popped the hood and we've looked deeply at the real net of fees performance of Hush's 3 risk profiles up through February 2026.
Yeah, we've seen the Protector deliver positive 27.82% by focusing on mitigating sequence of returns risk and providing a smoother ride.
We've seen the Strategist hit positive 30.87% with a highly balanced global approach.
And we've seen the Adventure top out at positive 35.87% by taking on more volatility for potential reward.
Right. And for you listening, I want to reiterate that while we have been looking strictly at a historical data set, and we all know past performance can never guarantee what will happen tomorrow, the real lasting value here lies in understanding the mechanics.
It's about looking under the hood and truly comprehending how a deeply diversified, momentum-based system operates in the real world.
The peace of mind that comes from knowing a system is mechanically designed to automatically cut losses on weak trends while aggressively capturing the upside of healthy markets no matter where in the world they happen to be located.
Thank you so much for joining us on this deep dive into the historical data. We love unpacking these complex mechanics with you. Keep exploring the underlying forces that shape the global markets, keep challenging your baseline assumptions, and most importantly, keep asking great questions. Until next time.